Most people come into trading believing the main challenge is finding the right strategy. They search for the indicator that predicts the next move, the entry pattern that wins more often than it loses, the system that removes uncertainty. It feels logical. If the method is strong enough, the results should follow. For a while, this belief is comforting. It gives the mind something to chase and something to blame when things go wrong. But after some time, a quiet realization begins to appear. The strategy was never the real problem. A trader studies charts for months. The rules are clear. The setup appears exactly as expected. The entry is obvious, yet the hand hesitates above the mouse. Something inside waits for a little more confirmation, a little more certainty. The moment passes. Price moves without you. Now frustration arrives. The mind reacts quickly. The next entry is rushed. Position size grows slightly larger than planned. The market turns. A small loss becomes a larger one. This cycle repeats so often that many traders start believing they lack intelligence or talent. In reality, something much simpler is happening. The human nervous system was never designed to operate comfortably in an environment like financial markets. When money is exposed to risk, the body reacts as if it is facing physical danger. The heart rate increases. Breathing becomes shallow. Muscles tighten. Attention narrows. These reactions are not weaknesses. They are ancient survival responses that protected humans long before modern markets existed. The brain interprets uncertainty and financial loss as a threat. In daily life, this response is useful. It encourages caution. It pushes us away from danger. In trading, it creates the opposite effect. It interferes with clear decision-making. The trader feels pressure to escape discomfort as quickly as possible. This is why winning trades are often closed too early. The moment the position shows profit, the nervous system senses relief. Locking in that relief becomes more attractive than following the plan. The trader exits quickly and watches price continue moving without them. Losses create the opposite reaction. Accepting the loss would end the trade and confirm the discomfort. So the mind delays the decision. It searches for reasons to hold. Maybe the market will turn. Maybe the analysis was still correct. Hope becomes a temporary shield against the emotional impact of accepting the loss. From the outside, these decisions look irrational. From inside the body, they feel completely logical. The nervous system is simply trying to reduce pain. Understanding this changes how trading should be approached. The goal is not to remove emotion or become fearless. That is impossible. The goal is to learn how to remain stable while the nervous system experiences discomfort. Professional traders are not people who feel nothing. They still experience uncertainty. They still feel tension when money is at risk. The difference is that they have spent years becoming familiar with that sensation. The discomfort is no longer interpreted as a signal to react. Instead, it becomes background noise. This shift does not happen through motivation or intensity. It develops through repetition and simplicity. When a trader follows the same clear process again and again, the mind slowly learns that the discomfort is temporary and manageable. At the beginning, every trade feels important. Each position seems to carry meaning about skill and intelligence. A loss feels personal. A win feels like validation. Over time, this emotional weight becomes lighter. The trader begins to see each trade as only one event inside a long sequence. No single outcome carries much importance. The focus moves away from being right and toward following the process. This is why experienced traders often use very simple systems. Not because complexity is impossible, but because simplicity allows the mind to remain calm. When the rules are clear, there is less room for internal debate. The setup appears. The position is taken according to the plan. Risk is defined before the trade begins. Once the order is placed, there is nothing left to argue with internally. The simplicity creates space for emotional stability. Many new traders resist this idea. Complexity feels safer. More indicators and confirmations create the illusion of control. It seems responsible to gather as much information as possible before acting. But too much information places the mind in constant analysis. The trader becomes trapped between conflicting signals. Decision-making slows down. Confidence disappears. Execution becomes inconsistent. Clarity often appears when unnecessary information is removed. One setup, one environment where the trader understands what they are looking for, one clear rule for entry and one clear rule for exit. Nothing dramatic happens when this simplification begins. The market does not suddenly become easier. Losses still occur. Uncertainty still exists. The difference appears internally. The trader spends less energy thinking and more energy observing. There is another shift that slowly develops alongside this process. Attention moves away from daily results. Early in the journey, the profit and loss number feels like the scoreboard of success. A green day brings relief. A red day brings disappointment. This emotional dependence creates instability. Because short-term outcomes in trading are unpredictable, the trader's confidence rises and falls constantly. Professionals eventually learn to measure something different. Instead of asking how much money was made, they ask whether the process was followed. Did the trade match the plan? Was risk controlled? Was patience maintained before entry? These questions may seem less exciting, but they create something far more valuable: psychological consistency. When execution becomes the primary goal, the mind stops reacting strongly to individual outcomes. A disciplined losing trade can still be considered a successful decision. A profitable trade taken outside the rules is recognized as a mistake. This perspective protects the trader from emotional swings. The market becomes a place to practice behavior rather than a place to seek validation. Another quiet habit begins to appear as traders mature. They reduce the amount of external information they consume. In the early stages, it feels necessary to read every opinion and watch every analysis. Each new voice promises a clearer understanding of the market. But constant exposure to outside perspectives creates internal noise. Conviction becomes fragile. The trader begins to doubt their own observations. Gradually, experienced traders learn to limit these influences. Not because other opinions are always wrong, but because clarity requires mental space. The market already provides enough information through price itself. Observing that information calmly is usually more useful than absorbing endless predictions. Silence becomes valuable. In that silence, patience grows. Patience in trading is often misunderstood as passive waiting. In reality, it is active discipline. The mind regularly pushes for stimulation. It wants to feel productive. It wants to participate. Choosing not to act can feel uncomfortable. Yet many of the best decisions in trading involve doing nothing. Capital is preserved. Emotional stability remains intact. Eventually, the trader realizes that the real skill was never predicting the market. It was learning how to remain balanced while participating in something inherently uncertain. This balance develops slowly, through repeated exposure to risk, through accepting small losses without resistance, through allowing profitable trades to unfold without interference. Over time, the nervous system adapts. The sensations that once felt overwhelming begin to feel ordinary. The trader sits in front of the screen with a quiet mind. A setup appears. The order is placed according to the plan. Whether the trade wins or loses no longer changes the internal state very much. Trading becomes calm, almost uneventful. And this calmness is often the first real sign that a trader is beginning to operate like a professional. At some point in a trader's development, another realization appears. It is quieter than the first one, but even more important. The market was never demanding perfection. It was only demanding stability. In the beginning, most traders try to control outcomes. They want to predict every movement and avoid every loss. This desire seems reasonable because money is involved. But the attempt to control outcomes slowly creates tension inside the mind. Every trade becomes a test. Every price movement becomes feedback about whether the trader was right or wrong. When the market moves in the expected direction, the body relaxes. When it moves the other way, the body tightens. This constant cycle of tension and relief drains mental energy. The trader begins reacting instead of observing. A small pullback inside a healthy trade suddenly feels threatening. The trader exits early to protect the profit. Minutes later, the market continues exactly as expected. Frustration appears. On the next trade, the opposite happens. A loss begins forming, but the mind remembers the previous frustration. Instead of accepting the stop, the trader hesitates. The loss grows larger. These reactions are not mistakes in logic. They are attempts by the nervous system to protect emotional comfort. The brain prefers immediate relief even when that relief damages long-term performance. This is why consistency in trading rarely comes from more knowledge. It comes from learning how to stay present while discomfort moves through the body. Discomfort in trading usually appears in three forms: uncertainty before a trade, fear during a trade, and impatience while waiting. Each one triggers a different response. Uncertainty appears when a setup forms. The trader sees the opportunity, but the future remains unknown. The mind searches quickly for reasons to delay the decision. Maybe the pattern is not perfect. Maybe another confirmation will appear. This delay is an attempt to remove uncertainty. But uncertainty cannot be removed. It is the permanent condition of markets. Professionals learn to recognize this moment clearly. The rules are already defined before the trade begins. When the setup appears, the decision is simple. Either the rules are present, or they are not. If they are present, the trade is executed without debate. This does not remove uncertainty. It removes hesitation. Fear appears once the position is open. Now the mind begins monitoring every small price movement. The body reacts to fluctuations in profit and loss. For many traders, this is the most difficult phase. The urge to interfere with the trade becomes strong. Watching the numbers change activates the same neural circuits involved in other forms of risk and reward. Experienced traders often reduce this stimulation deliberately. They already know their risk. They already know their exit conditions. Staring at every tick adds nothing useful. Instead, they allow the trade to unfold with minimal interference. The market either reaches the target or the stop. The trader's responsibility was already completed when the plan was followed. Impatience appears during quiet periods when nothing is happening. This phase is often underestimated because it feels harmless. The market is slow. Hours pass without opportunity. The brain begins searching for stimulation. Small movements start to look like potential setups. The trader feels the need to participate. Many unnecessary trades begin this way. Patience is not simply the ability to wait. It is the ability to remain comfortable while waiting. That comfort grows only through experience. A trader who has seen hundreds of opportunities understands that missing one moment does not matter. Another opportunity will eventually appear. This understanding creates emotional space. Instead of chasing activity, the trader allows the market to come to them. Over months and years, these habits begin shaping a different identity. The trader no longer experiences the market as a constant threat. It becomes an environment where disciplined behavior can be practiced. Losses still occur. They always will. But a loss is no longer interpreted as personal failure. It becomes information about probability playing out. This perspective removes much of the emotional weight attached to trading. The trader can close a losing position calmly and move on without internal conflict. Interestingly, this calm behavior often produces better results, even though profit is no longer the main focus. When the mind is stable, it becomes easier to follow risk limits. Position sizes remain consistent. Decisions remain clear. Over time, these small behaviors compound into sustainable performance. Many people search for a dramatic moment when they suddenly become a successful trader. In reality, the transformation is gradual. One day, the trader notices they did not check their profit and loss for hours. Another day, they realize they closed a losing trade without frustration. Later, they observe that waiting for a setup no longer feels uncomfortable. These small shifts signal something important. The nervous system has adapted. The market has not changed. Volatility still exists. Uncertainty still exists. What changed is the trader's relationship with those conditions. Instead of fighting uncertainty, the trader accepts it as part of the environment. Instead of avoiding discomfort, the trader allows it to exist without reaction. This acceptance creates a quiet confidence, not the excitement that comes from a big winning trade, but a steady sense of control over one's own behavior. And that control is the real foundation of long-term survival in trading. Most traders believe the turning point in their journey will arrive when they finally understand the market. They imagine that one day the patterns will become obvious and decisions will feel easy. What actually changes is something much quieter. They begin to understand themselves. In the early stages, a trader is constantly reacting. Every movement on the chart seems meaningful. Every candle carries emotional weight. A small move against the position feels like a warning that something is wrong. A small move in favor feels like confirmation that the decision was correct. This sensitivity makes the experience exhausting. The mind stays alert, scanning for danger or validation. Over time, this constant tension erodes discipline. A regulated trader experiences the same movements but interprets them differently. A single candle means very little. A small fluctuation inside a position does not require attention. The trader already defined the conditions of the trade before entering. Because of this preparation, the mind does not need to negotiate with every change in price. Preparation is often misunderstood in trading. Many assume preparation means studying more charts or collecting more analysis. Real preparation is simpler. It means defining risk clearly before the trade begins and accepting that risk completely. Acceptance is important because partial acceptance creates conflict. If the trader secretly hopes the stop will never be hit, then every movement toward that level produces anxiety. But when the risk has already been accepted, the stop becomes just another part of the structure. If price reaches that point, the trade simply ends. There is no argument with the market. This approach transforms the emotional environment of trading. Instead of constantly defending against loss, the trader allows each trade to play out inside predefined boundaries. Risk becomes contained. Small position sizes support this stability. When the amount at risk is modest, the nervous system can remain calm. Decisions remain clear. The trader can observe the market without feeling threatened. Large positions create the opposite effect. Even a small movement begins to feel important. The body interprets the exposure as danger. Attention narrows and discipline weakens. For this reason, experienced traders often prefer smaller positions than beginners expect. The goal is not to maximize excitement or speed. The goal is to maintain clarity. Clarity allows the trader to notice subtle changes in behavior. For example, the moment when impatience begins to appear, or the moment when fear encourages an early exit. Instead of reacting automatically, the trader becomes aware of these impulses. Awareness creates a small pause between emotion and action. Inside that pause, discipline can operate. This skill develops gradually through repetition. Every time the trader follows the plan despite discomfort, the nervous system learns that stability is possible. The experience becomes familiar. Over many trades, this familiarity reduces emotional intensity. What once felt stressful begins to feel routine. Routine is an important word in professional trading. From the outside, trading may appear dramatic and fast-moving. From the inside, it often feels slow and methodical. The trader reviews the market. A few conditions are observed. Most of the time, nothing requires action. Occasionally, a setup appears and the process repeats exactly as it did before. Entry, risk defined, observation, exit. The repetition may seem uneventful, but this is precisely what allows emotional regulation to strengthen. The mind no longer experiences every trade as a unique event. It recognizes the pattern of behavior. As this recognition deepens, something else changes as well. The trader stops trying to prove anything. Early in the journey, many decisions are influenced by a subtle desire to validate oneself. A winning trade feels like evidence of competence. A losing trade feels like doubt. This hidden pressure creates unnecessary intensity. The trader becomes attached to being right. With experience, that attachment fades. The trader begins to see that the outcome of any single trade carries very little meaning. Even the best setups sometimes fail. Even poor decisions occasionally produce profit. Once this is understood deeply, the need to defend every trade disappears. The trader can enter a position with a calm mind because the outcome does not threaten their identity. The only responsibility is to follow the process with honesty. Honesty in trading means recognizing mistakes quickly. If a rule was broken, the trader acknowledges it without justification. The goal is not to protect pride, but to maintain clarity. This honesty also extends to patience. There are long periods when the correct action is to remain inactive. Instead of forcing activity, the trader allows the quiet moments to exist. Capital remains preserved. Emotional energy remains steady. Over time, these behaviors create a stable rhythm. The trader arrives each day with the same intention. Observe carefully. Act only when the plan requires it. Protect capital first. The market continues to move unpredictably, but the trader no longer feels pushed around by every fluctuation. There is a sense of distance between the external movement and the internal state. Losses still occur, but they pass quickly. Wins still occur, but they do not create excitement. Both outcomes are simply part of the statistical process unfolding over many trades. This calm perspective allows the trader to remain present for long periods without fatigue. Decisions remain deliberate rather than reactive. Many people expect success in trading to feel dramatic. In reality, it often feels quiet. The trader sits in front of the screen, observing patiently. Hours may pass without action. When the right moment appears, the trade is placed without hesitation. The risk is small and already accepted. Then the trader waits again. This rhythm may appear simple from the outside, but internally it represents a profound shift. The person who once chased excitement and certainty has become someone who values stability and patience. And that shift is what allows long-term participation in an environment built on uncertainty. In the later stages of a trader's development, something subtle but important becomes visible. The market no longer feels like something that needs to be conquered. It becomes an environment that requires cooperation. Earlier in the journey, the trader tries to impose expectations on price. A pattern appears and the mind immediately forms a prediction about what should happen next. When the market behaves differently, frustration follows. This frustration is not really about the trade. It comes from the gap between expectation and reality. The professional mindset approaches the situation differently. Instead of demanding that the market behave in a certain way, the trader observes what is actually happening. The plan provides structure, but it does not create attachment. If the setup appears, the trade is taken. If the setup fails, the loss is accepted. Nothing in this process requires emotional resistance. This attitude allows the trader to remain flexible. The market is constantly changing. Volatility expands and contracts. Trends appear and disappear. A rigid mind struggles to adapt to these shifts. A regulated mind stays attentive. Attention in trading is quiet. It is not the intense focus that comes from excitement or fear. It is a steady awareness that notices information without rushing to interpret it. This quality of attention grows stronger when the trader removes unnecessary pressure. There is no need to trade every day. There is no need to prove anything within a short period of time. The trader simply participates when conditions match the plan. Small position sizes continue to support this stability. With limited exposure, the trader can think clearly even during uncertain moments. Losses remain manageable, and the nervous system stays calm enough to learn from each experience. Learning in trading rarely comes from dramatic events. It comes from repeated observation. A trader notices how their mind reacts during a losing streak. They observe the subtle urge to change the plan after a few losses. Instead of immediately reacting, they allow the feeling to pass. Later, they notice the opposite reaction during a series of wins. Confidence grows and the temptation to increase size appears. Again, the trader observes the impulse without acting on it. Through this process, the trader begins to understand that emotions rise and fall naturally. They do not need to be suppressed, and they do not need to control behavior. They can simply exist. This realization creates a form of emotional independence. The trader no longer waits to feel confident before executing a trade. Confidence is not required. Only clarity and discipline are required. Over time, this approach transforms the identity of the trader. At the beginning, trading felt like a test of intelligence or courage. Each trade seemed to reveal something about personal ability. Now trading feels more like a practice. The trader shows up each day to apply a simple process. Some days produce profit. Some days produce losses. Most days are quiet. What matters is the consistency of behavior. Consistency is built from small actions repeated over long periods of time. waiting for the correct setup even when the market feels slow, closing a losing trade without hesitation, allowing a profitable trade to reach its planned exit without interference. None of these actions feel dramatic, yet together they create a stable foundation. The trader who once searched endlessly for better indicators now understands that clarity came from reducing noise. The trader who once tried to predict every movement now understands that participation only requires probability. Most importantly, the trader who once tried to avoid discomfort now understands that discomfort is simply part of the environment. When uncertainty appears, it is not a signal to escape. It is a reminder that the market is functioning normally. When a loss occurs, it is not evidence of failure. It is one outcome inside a long sequence of trades. When patience is required, it is not wasted time. It is the space where discipline strengthens. With this perspective, the relationship with the market becomes calm and sustainable. The trader is no longer chasing constant activity or emotional stimulation. They are protecting something more valuable: clarity of mind. From this place, decisions become simple. The plan defines the structure. Risk remains small. Execution remains consistent. Each trade becomes just another repetition of the same process. Months pass, years pass. The trader continues showing up with the same quiet discipline. And slowly, the results that once felt distant begin to appear. Not because the trader finally discovered a perfect strategy, but because they learned how to remain stable inside uncertainty. This stability is what allows the trader to survive long enough for probability to work in their favor. In the end, the market does not reward those who chase excitement or certainty. It rewards those who can remain balanced while participating in an unpredictable environment. A trader who can accept uncertainty. A trader who protects capital before seeking profit. A trader who executes a simple process without emotional reaction. That kind of trader does not need constant validation from the market. The discipline itself becomes the measure of success. And once that mindset becomes natural, the activity of trading becomes quiet, steady, and sustainable.